All right, I'll get started. Last couple of times we've done these, I've had people trickle in throughout the hour. I'll wait. Are you guys both ready to get going for a sec? Hi, Robbie. Good to meet you. And hi, Evan. The last couple ones I've held, we have people trickle in the first 10, 15 minutes. So I'm going to go ahead and get started. I wanted to do a quick introduction before I jump in to the slide. So first of all, my name is Justin. My last name is Walsh. And I run a branch, a mortgage branch here in Southern California, down in Ladera Ranch in Orange County. I've been in the industry for 12 years. I've got two daughters at home that are 4 and 6 years old. And I've ran a small kind of boutique setup for a number of years lately. And entering the 2022 market, especially the latter half of this year and going into 2023, I kind of realized that there was like a lot of misinformation going on and a lot of folks looking at the wrong things, right? Especially coming off of a 2020 and 2021 market where there was a lot of very interesting elements that occurred. And I've always been someone that wants to communicate more in-depth facts to my buyers than what I believe other lenders are able to offer in that regard. And I started really looking closely at what are the pros and cons of 2021 versus what we're likely going to see in 2023. And in those discussions, we've had a lot of really good traction still with buyers and with our current referral partners. And my intent with holding these webinars is mainly just to inform. You know, we have room if we could help. We do have some room. We don't have a ton of capacity to help a million agents, but I'm going to go through visuals. And if anything, you're going to be able to have some talk tracks after this that are going to be really insightful. And you'll be getting a bunch of content from me that's buyer facing following this Zoom call. Short videos on relevant topics that buyers just frankly need to see right now to actually have a better understanding of what's occurring. So I'm going to jump right into it. I'll definitely open it up for questions after, and I'm recording this one too so that you guys have something to go back to if that helps, okay? Awesome. Give me just a second here. Can everyone see my screen okay? Awesome. So this is all going to be dedicated towards buyer conversion and the relevant topics that need to be talked about. And I think one of the things that's occurring out there is, especially on the lending side, you had this 2020 and 2021 market where honestly mortgage lenders, not all, but most, were able to get a little bit complacent because things were too easy for those years for loan officers, right? And fast forward into this really abrupt rate spike, and I will be the first person to tell you, like it takes an absolutely well-rounded approach with that buyer right now for them to understand what are the pros and cons of entering the market right now as a home buyer, right? If there's simply a rate that's being quoted and that pre-approval conversation simply consists of a 7% or 6.5% rate and this large monthly payment, buyers are not going to wrap their heads around that. And they're going to go cold, and they're going to go cold, and they're going to go cold. And there's going to be this repetitive cycle when in fact, there's a lot more going on, especially entering the first couple months of 2023. So the main topics are going to be buyer conversion. You know, that's dwindling without the right approach. And I believe that's 100% preventable. And unfortunately, especially on my side of things, there's going to be a lot of agents, loan officers, shoot, even escrow officers that just don't make it through next year without major adjustments, right? And I think if agents are in fear, if lenders are in fear, buyers are just going to continue to wait. And what are the silver linings of higher rates? What are 2023 rate forecasts? What's the Federal Reserve saying about rates? What's likely going to occur with inflation? And then how does buying in 2021 versus 2023, how does it actually compare for a buyer? And what type of visuals are we giving those buyers to help them understand what those advantages are? And converting buyers, it's 100% a joint effort between the agent and the lender. Like I was saying earlier, if a realtor has all the optimism in the world, they understand how to communicate the tax benefits in 2023, why buying into a buyer's market and buying some of these price reductions, what are the benefits there? But then they get to the lender and there's no context in that conversation. And it's simply, hey, pre-approval, and then here's your options, a 7% rate or a 7.5% rate. The conversation cannot go that way, or else these buyers just don't have a chance. Despite an agent doing everything in their power to have a great conversation and talk track. And I think on the bottom item here, one of the biggest ones that is not talked about enough quite yet, how do tax deductions and also seller credits drive down monthly costs? And I'm going to go into some examples there. But simply put, right now, buyers are nervous, and that's a given. And if the lending partner and the real estate agent, if they're not doing everything in their power to address those nerves, then the buyer conversation is going to, or the buyer conversion, I'm sorry, is going to continue to suffer. Most buyers just need that help taking a collective deep breath before going out and submitting offers right now, right? And that conversation for me has oftentimes been when I've gone over their purchase report. We do these very comprehensive purchase analysis reports that I'm going to show you guys in a couple slides. And there's that moment in that call where that you hear them kind of exhale and say like, yes, I can do this. In particular, the first time and second time home buyers that missed 2020, missed 2021, and now due to higher rates, they had a bunch of concern. And when we get them looking at all of the right facts there's that moment and that exhale that allows them to actually go out there and start submitting offers. But there's a big conversation that has to occur around that didn't have to occur in prior markets to get those buyers to move forward. And again, just to repeat myself, if that pre-approval and that rate and payment conversation with the mortgage lender, if it lacks substance and key talking points, I mean, that buyer's chances of going cold haven't been higher in more than a decade. One of the things I want to definitely point out, so the silver lining of higher rates, and it's very important realtors and loan officers understand this. So tax deductions are back, and they're not just back, they're having a really major impact on home buyers that are going into escrow right now. So I'm going to try to explain this. I have some separate videos that kind of wrap up this whole concept in a couple short minutes, but assuming that your client itemizes their tax deductions, which pretty much everybody that can qualify right now does itemize their taxes. So assuming your client itemizes their tax deductions, when you have a higher interest rate, there's a much larger tax deduction that's going to occur for that buyer, okay? When you're paying double the interest, you're going to have a much larger write-off. So the way this works, for those that aren't aware, buyers can write off mortgage interest up to $750,000 of their balance on their primary residence, and then up to $10,000 in property taxes, okay? So a $700,000 mortgage last year, for example, at 2.875, that buyer was only paying just under $20,000 in mortgage interest. Okay, fast forward to today, in a $700,000 mortgage at 6.75, for example, there's $47,000 in annual interest that they're paying. So I'm going to stop there. What occurred last year in 2020 and 2021, everyone's tax scenario is a little bit different, but there's a few key components. So if you were married and filing jointly in the last couple of years, you had a standard tax deduction of $25,900, okay? If you can mute it for me, I appreciate it. So if you have a standard tax deduction of $25,900 and you're only paying $14,000 in mortgage interest and maybe another $6,000 or $7,000 in property taxes, your property ownership is still several $1,000s short of that standard deduction, right? So maybe you have some charitable donations, maybe you put some money towards a 401k, but there were a lot of scenarios out there last year, especially on slightly smaller loan amounts, where for the first time ever, homeowners were not itemizing their mortgage interest on their properties because rates were so low and standard deductions were so high. And that wasn't the case for everybody. Like some larger loan amounts and people that had other deductions were able to write off some of that interest, but tax write-offs were very, very low and in many cases non-existent for homeowners in 2020 and 2021, okay? Obviously rates were low, which is great, but the tax benefit for the first time in history was very minimal, right? Now that rates are much higher, that's changed. So we always advise them to have another conversation with their CPA, but we know exactly how these deductions work. And I can tell you that it's ranged between $400 upwards of $900 per month that buyers have been able to increase their tax benefit by because they're purchasing at these higher rates, okay? That's a very real thing that's occurring present moment, okay? So the rate's higher, but the tax deduction's higher, especially relative to what it was last year. And again, we have some really good buyer-facing videos on this topic, because I can tell you in conversations that I've had, number one, it's not factored into buyer decision-making right now. And number two, once they understand that tax benefit in the conversations that I've had with them, there's a lot of intrigue. Like the response quality is very, very strong on this topic because obviously everyone hates taxes, and that is a major silver lining of what's occurring right now. Another thing I want to point out is seller credits. So mortgages have never been more expensive for borrowers. That's another headwind that all buyers are facing, is most mortgages are not very cheap right now. And there's a reason for this. The big banks that are lending out this money, they expect rates to come down, okay? They feel like there's a much stronger chance that rates go lower from here and not higher. And because of this, these lenders are not anticipating that buyers are going to be in their mortgage for a long period of time, okay? So they're not giving a lot of money up front to these buyers, okay? So if mortgage lenders expect homeowners to be in their mortgage for 12 or 14 months, they're not gonna give you a $5,000 credit up front because they would lose money on that transaction if that buyer's only in that loan for 12 months or 14 months. So mortgages are expensive at any bank right now, okay? The other thing that's occurring right now, in a normal market, if you are a home buyer and you pay 1 point, okay? So if you choose to pay a point to get a lower rate, in a normal market, that would lower your rate by 0.25% on the interest rate. That's always been the case for a decade plus. 1 point will pay for 0.25 lower in rate. Right now, 1 point is getting anywhere from 3/8 to 0.5% lower in rate. Okay, very unique circumstance. So like a 2% seller credit will oftentimes drive down the interest rate an entire 1 percentage point for that buyer. Okay, I'm going to showcase a visual here. This might be tough for you guys that are on your phone to see this, but this is a scenario where there was a verbal acceptance at a purchase price of $775,000, okay? So what does it look like buying that property at $775,000 with no seller credit versus buying that property at $800,000 with a $25,000 seller credit, okay? So in one scenario, it's a lower purchase price. The other scenario, it's a higher purchase price, but utilizing a large seller credit to buy down that rate. The main thing that you're gonna see, and this is in almost every scenario right now, in the last 15 to 20 escrows we've opened have all had seller credits by me working with my agents. The higher purchase price on the right-hand side with that seller credit produced a monthly payment that was $235 less on the payment and also $7,000 less at closing, okay? So that seller credit not only paid for the rate to be almost a full percentage point less, but that seller credit also drove down the closing costs an additional $7,000, okay? In most scenarios, as long as we know that that home will appraise, it's going to be better to have a seller credit involved than an additional price reduction, because it'll get that buyer that lower rate. It'll drive down their monthly payment. And in most scenarios, it'll also lower the amount that they need to bring to closing. So seller credits are better than additional price reductions. Okay, so if there's an opportunity to do that, this is something I communicate thoroughly with all buyers, is that if there's an opportunity to pursue that seller credit, it's definitely going to weigh heavily in their advantage to obtain that seller credit versus another $10,000 or $15,000 lower on the price. Okay, now to the even more important stuff. So I have visuals here on what it looks like having bought in 2021 versus buying towards the end of this year, early 2023. Obviously, this is an example, so there's going to be unique scenarios for this, but I have been producing this type of document for buyers as the market has continued to weaken a bit, to showcase to them, here's the advantages of 2021, and here's the advantages of 2023, okay? So let's assume a buyer purchased a property in 2021 when demand was sky high, and they paid $1 million for a property with 20% down, okay? The advantage in 2021 was that the rate, let's say it was 3.125. The disadvantage was there was so much demand that folks had to obviously pay a premium to get into a property, okay? So that 3.125 rate produced a payment of $4,423, which includes property taxes and insurance. But now fast forward to 2023, and let's say we have a 15% value decrease, okay? So now that property is worth $850,000 that the individual bought last year for $1 million, okay? And again, this is an example of, I think, of a high potential of what we're going to see, at least for the first part of 2023. So they would still obviously have that same original finance loan amount of $800,000 versus this column over here, the second column to the right. Let's say a buyer purchases the property in 2023 at that 15% price reduction. Okay, so instead of paying $1 million for that property, they're able to get into escrow for $850,000. Their loan amount is only $680,000, which is $120,000 less. The rate is substantially higher based on current rates, 6.5%. And therefore the monthly payment, even though there's a 15% price reduction, the monthly payment's still $700 more per month, okay? The column below this is where things start to get interesting. So as I mentioned, last year, there were very minimal tax benefits on these property purchases because property taxes were so low, or sorry, more interest rates were so low. Fast forward to these 6.5% rates. So this is a $200,000 income earner. Them purchasing this property at 6.5% would have $850 more per month in tax benefit than had they bought last year at that lower rate, okay? So when I talk to clients about this, they're going to get either a much larger refund due to this large tax benefit, or they can adjust their withholdings. And this is where I highly encourage them to go talk to their CPA and have a game plan. But buyers can adjust their withholdings on a month-to-month basis based on that CPA's recommendation, so that they're taking home more money per month because now they have this huge tax benefit. That's step number one. Step number two is, what is buying last year versus this year? What does that look like 5 years into owning that house? So these middle two columns are what you want to pay attention to. So again, the second column to the left is someone that bought the house last year for $1 million, 2023 as a 15% price reduction, and then things stabilize, and let's say we have a 4% property appreciation per year for the next 5 years. The buyer that bought in 2021 that had that initial price reduction, At the end of 5 years, they would have $321,000 in equity. The buyer that bought during those price reductions, the one that waited and purchased in 2023, despite having a much higher rate, because they bought that market weakness, they would have $397,000 in equity after 5 years because of that variance in purchase price. So despite the interest rate being more than double, they would have over $70,000 more in equity than the individual that bought last year. This isn't factoring in the ability to refinance that mortgage, okay? It's not factoring in the additional savings that would come with a lower rate. These visuals, in my opinion, are critically important because there are going to be a lot of pros versus cons to buying in a buyer's market this coming year, and buyers need to see this stuff, because if they're just looking at the rate and payment, I can tell you that 9 out of 10 times they're not going to be able to configure the tax deduction. They're not going to understand how that works, and they're also not going to understand the pros and cons of buying in 2021 during the frenzy versus buying in 2023 when significantly less people want to buy. Here's another visual of buying in 2021 versus 2023 on a 15% price reduction, just to see kind of all the math that goes behind this. So again, 2021 drop in value. So the individual that bought in 2021 that sees a 15% reduction before things stabilize, this is what their loan balance would be at the end of 5 years, $712,000. Home value would be $1,034,000. This is a 4% appreciation rate over the next 5 years, just for example purposes. This is how much they would have paid in total payments relative to the 2023 buyer that bought at a higher rate but at a lower price, 15% lower price. And again, the $76,000 more in equity that that buyer would have waiting till this coming year. We also have rent versus own summaries that are very, very important. I think as a realtor, understanding who your buyer's talking to and what that conversation entails is one of the biggest takeaways from this conversation, because I think we're going to see a lot more first-time home buyers, in my opinion, in 2023 than we're able to purchase in the 2020 and 2021 markets, right? People with 10% down or 5% down are going to obviously be able to enter the market if and only if they're educated properly. So this is a scenario, this is a like for like example, renting a property versus buying that same property, okay? And for those that can see this, right now, given current rates, you're looking, if the rental payment's $4,500 a month, the rate at 6.5% and the payment at 6.5% would be almost $6,500 a month with taxes and insurance, okay? Then comes the tax advantage. So if you look right below, first-time home buyers have to understand the tax benefit of entering homeownership, especially at these higher rates. And then they're also going to have to understand and be able to visualize with these reports how much money is going into principal each month in that first year. So a $4,500 payment in rent, the tax benefit is going to be non-existent as a renter. They're just going to use their standard tax deduction 9 out of 10 times. So their net monthly payment as a renter is going to be about $4,000 a month after their tax benefit. And then comparing home ownership, their payment would be $6,500 per month. However, the tax benefit is more than $800 more per month than what they get as a renter. And they're paying themselves $760 per month towards their equity. So their net monthly payment at this purchase price would be $4,400. At a slightly lower purchase price, $4,145. And then at a $950,000 purchase price, $3,893. That's step one in getting a first-time home buyer to visualize tax benefit and then paying into their own asset relative to rent. The next step is making sure they understand that they're going to be able to refinance at some point when rates do improve. This is not going to be their forever mortgage. They're simply dating their mortgage, and once there's a better option, they can leave the old one and take the new one. But let's just say that didn't happen. How does it compare renting 5 years from now versus owning? Okay, so in these models that we use, I often use a 3% rental increase versus a 4% property appreciation. I can change those at any time, but those are pretty standard what I use on these reports. So in 5 years, this first-time home buyer would have paid $257,000 in rent versus $327,000 in mortgage payments. Okay, so obviously a substantial amount more on the mortgage payments. But during those 5 years, they paid $46,000 towards their equity, and they were able to obtain $29,000 more in tax write-offs through mortgage interest and property taxes. So once you factor in those property taxes and the write-offs and the principal paid, their net cost was $220,000 buying that house versus $226,000 in renting. Okay, well, now comes the property appreciation. So if your home increases by 4% per year, in just those 5 years, you've been able to establish $420,000 in equity versus $0 as a renter. Okay, and then the 15-year outlook, which obviously makes these numbers grow even further. I can tell you that the 5 and 15-year outlook on renting versus owning is the most critical piece of information for people to see on top of the tax benefit. So the 5 and 15-year stuff has always been important when we've done our purchase consultations, but the tax benefit is obviously a much newer conversation now that rates have gone up this much. But this is everything, because the short-term fear is that, oh my gosh, my payment's going to be $2,000 more per month. But then the reality is there's going to be a big tax advantage for these folks that are buying with these higher rates. And let's just assume the property appreciation is 4% over the next 15 years, which is a very conservative number relative to what's happened over the last 15 years. And they would have paid $901,000 in rent during this 15 years versus $982,000 in mortgage payments. But in those mortgage payments, they paid down their loan by $200,000. They obtained $155,000 in tax benefit during that time. So now over 15 years, their net cost is $170,000 less than renting. And this is without factoring in a refinance. Okay, so one thing these buyers need to understand, a 1% reduction in rate would increase this net cost or decrease this net cost by a substantial amount. And that's just with a 1% reduction in rate. But after 15 years without refinancing, at a 4% property appreciation, their home would be worth $1.6 million. Their loan balance would be $522,000 and $1.1 million in equities established. And this is the visual. This is the visual that I typically talk to them about, all the same emotions that their parents, if they were homeowners, or their grandparents were homeowners. Like every single generation that's entered homeownership has had a relatively significant amount of initial fear and anxiety over that monthly payment. But then time passes, and at some point, your kids and their kids will look at your mortgage payment or look at what you paid for a home, and they will think that somehow you cheated to get that payment. The same way we look at our last generation's mortgage payments, right? And really helping them understand and just realize on an emotional level that every single homeowner that's entered homeownership, whether it was 40 years ago or today, there is that initial payment shock, and there is that initial just emotional stepping stone that you step over. And then over time, because it's a fixed asset, that's going to continue to devolve into a very reasonable amount. And the tax benefits the principal being paid, the decrease in mortgage balance, the likely decrease in rates, all of that stuff will eventually yield to even lower and lower payments with an appreciating asset. So jumping right through it to finish up, I mentioned this earlier, homes are permanent, loans are not. So buyers do need to understand the likelihood of them being able to refinance to a lower rate in the first couple years of home ownership is pretty darn high. Nobody's going to know when that's going to occur. So planning on that refinance is irresponsible, but they need to understand that the likelihood of that occurring is going to be sky high. All home buyers that we're representing are getting a $2,000 credit that they can use to cover the lender fees when that refinance occurs. We do watch rates very, very closely for past home buyers, so they know when it's time to refinance. And at some point, a lower payment will become available. And it's important for homeowners, especially first-time home buyers, to know that. And I think it's important to note as well, inflation right now is at 8% as of the last inflation report. In the Federal Reserve's last meeting, they forecast inflation to be at 3.5% at the end of next year. Okay, so when inflation starts to get better, a lot is going to change in the market rather quickly. Whether inflation begins getting better in 4 months, 6 months, 12 months, that's anyone's best guess, but the market will change when inflation improves. Rates will stabilize, home prices will stabilize. Some of that buyer leverage will obviously go away at that point. And more importantly, the ability to refinance will open back up. Here's just another example of the long-term real estate trends. This is vital for buyers to see right now. They have to see the bigger picture because the short-term fear does not outweigh the bigger picture investment that they're making. You guys making that statement and then your lender backing those statements up and reaffirming those statements is very critical at the present moment. It was much less critical when rates were 2.875. Right now, I would say it's urgently critical for both parties to be communicating the same things. And again, when inflation starts to cool off, we're going to see a drop in rates. Demand will obviously pick back up. Homeowners that purchased at higher rates will be able to refinance, and home prices will likely stabilize and start increasing again. Because the crux of what's occurring right now is all inflation driven. So in summary, every buyer is unique, right? You're going to have your step-up property buyers, first-time home buyers. Every situation is unique. So those purchase reports that I was showing you guys, those have to be creatively configured to your buyer so that they can see all of the elements pertaining to their scenario, okay? One thing that buyers need to understand, and one thing we're including in those purchase consultations, however, is there's a lot of reasons why the 2023 buyer is going to be making a smarter investment than the 2021 buyer, right? There's a lot of compelling facts behind that based off of the figures and the images that I showed you guys. Buyers need a thorough and calming approach from the mortgage professional and from the realtor. I think it all starts with calm and confident statements, you know, because the news and everything media driven right now is relatively doom and gloom. And I know that just calming statements to buyers when socializing or prospects when socializing on how 2023 is going to have way more advantages than 2021 did. And they should take a closer look at all the facts. Like those type of statements are where things start. It's going to be very, very helpful for those of you that see the value in what I'm talking about, which I would hope is all of you. It's going to be very helpful to have your buyers request a purchase report analysis, okay? That purchase report analysis is the same thing I was showing you guys before, which has all of the information located in there. The rate, the payment, the tax benefit, the 5-year outlook, the 15-year outlook, rent versus own when appropriate. All of that information is stored in that purchase report analysis. Buyers are not committing to buying a property by receiving one of those, but they're going to get all of the facts pertaining to their scenario and their wish list. And they need all the facts right now to make an educated decision. So in the content that we're going to send you and some of the follow-up emails that we'll send you, there's going to be very easy ways for your database or your clients to request these reports. And we can review those reports with them, which is going to be even handier. So they actually have myself on a Zoom call going through it with them. And that's where perspective begins to shift drastically towards understanding the pros of buying in 2023, and all the ways that it's going to impact them financially for the better. Okay. So that is a wrap. I will be sending out those emails. It's going to have a wealth of stuff in there, higher rates and tax benefits, buying in 2021 versus 2023, seller credits versus price reductions, long-term investment forecasts, which is some of the stuff I showed you guys on here, rent versus own. These are all short buyer-facing videos that you'll be able to forward to folks on a case-by-case basis, just to help plant the seed and get the conversation going over things that they need to see right now. And I know that's been tremendously helpful for the folks that we already work with, is just having 3-4 minute videos that they can send to certain clients on rent versus own examples, and really start getting them to want to pursue those purchase reports so they can see exactly what would be going on with their scenario. So I appreciate you guys attending. I do have some time for a few questions if you guys have any, if any of you want to hang on here and ask some of the things that you were thinking about. And if not, no problem. Anybody?
I can't think of anything right now, but I'm sure I will have some questions in the future. But thank you so much. This was really great and very informative.
Yeah, there's a lot there.
Yes.
So in the emails that I'm sending, it's going to be much more compartmentalized on topics. But that was the general overview of what needs to occur. And 95% of that communication needs to be coming from the person doing my job, right? But the seed planting, I would say, needs to be there. We're in a time right now where potential buyers need to be educated, especially the first-time home buyers, maybe the second-time home buyers. Like, they need more facts, because just looking at the fact that rates are high and seeing just that in the news and letting that completely change their perspective is false. It's 100% false. I can tell you, I would rather enter the market during this weakness than during the 2021 period, 100%. Knowing what I know, there's not even a contemplation there, right? So how do we communicate that to more folks so they understand? And even simple statements. I think people need to be reminded that smart money tends to buy assets when nobody else wants to buy them. And smart money likes to sell those assets when everybody wants it, right? That's, the Warren Buffetts of the world, like, that's their investment strategy, is to buy when no one else wants to buy and then sell when everybody wants to buy, right? And there's some truth to that too, because there's going to be, it's anyone's best guess, but there's probably going to be a short window of time here in 2023 where there's a lot of negotiating power, and then that can abruptly change with tempered inflation and the Fed stops raising rates. I mean, that'll change quickly when those news cycles start to hit.
So you were saying that the big banks are really expecting interest rates to drop sometime next year, and so they are unwilling to give much credit to
Correct.
their buyers because they think that they're going to refinance in less than 10 years or something like that.
Much less than 10 years. Normally banks forecast their payment collection like on a 5 to 6 year model. So like historically, homeowners stay in the same mortgage for about 5 to 6 years. Right now, they're anticipating a possibility of 7 months, 12 months. they're prepared for that. So they're not going to make mortgages as cheap up front. They need to collect a little bit more money up front, because if all these folks stay in that loan for 7 payments, I mean, nothing happened there and they lose their butt, right? That being said, the pros to that is you can actually get a lot farther down on the rate with a modest seller credit. So that's why I wanted to talk about that, as a 2% seller credit can be the difference in a full percent less on the rate versus no seller credit. So those have been very, very helpful in the last dozen plus contracts that we've set up with the agents that we work with.
And then now, or pretty soon, the 1 point equals more than a 0.25% drop in the interest rate. You said at like 0.38 to maybe even a half.
Maybe even half, yeah. There's a lot of scenarios with like highly qualified homeowners where a 1% or a 1 point buy down, as I'm sure you're familiar with, is the equivalent of a 0.5% on the rate. Absolutely. Any other questions from anybody? You guys are more than welcome to call me if needs be. I'll let you know this, like as I mentioned in the beginning of the slide, we do have availability to work with some clients. We're about a $10 to $20 million a month branch. So last month we closed about $12 million in mortgages. Most of those are purchase. But I have a team of 7 loan officers here that are all individuals I've worked with for a number of years. We have our underwriters in-house. We have every jumbo product, stated income product, bank statement product. Like we have too many products. So there's something to fit every buyer. But there's some room for capacity, 100%. So in terms of me holding these webinars, it was equal parts to inform and then also to let you guys know that I'm here. And that communication with that buyer, man, has there ever been a time where that needs to be perfect and well executed by the lender? 100%. It is really, really important, and it needs to be thorough. It needs to be patient, reassuring, empathy, looking at actual facts. Like all of those things have to occur from a communication standpoint, or you have another person waiting.
Absolutely. And, you know, people are getting loans now, or they're getting pre-approved and then, you know, backing out or saying they still want to wait. And so it should be communicated on the front end before they go and have their credit run and everything.
100%.
Just one more thing, Justin.
Yeah.
Heidi couldn't make it today. She's trying to help her grandson get his license and had some car things going on. But she said that you were having another Zoom conference on Thursday.
Correct.
At 2?
At 1 o'clock. Yeah.
At 1 o'clock. Okay, same time.
Yeah. So I can send that link out. It's the same link that you guys used to sign up for this one. There's Tuesday and Thursdays at 1 p.m. for the month of November was my plan on holding these. So I think we have about 10 individuals signed up for Thursday, and I'm limiting it to 20. So it's not. I appreciate everyone being on here. I'll look out for the emails from me, and then feel free to call me directly if you have questions. If you get my voicemail, I'll definitely call you back same day. Bye, everybody.